Good morning and welcome to the WINKWORTH PLC interim results for the 6 months ended 30th of June 2022 investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Andrew Nicol, CFO, and Dominic Agace, CEO. Very good morning to you.
Good morning. It's a pleasure to be here to talk through the results of the first half of 2022. So on that note, I will turn to slide 3. So I thought it would be best to start with a sort of intro for those who don't know what the WINKWORTH system, the franchise model we run, just so sort of a couple of bullet points on that really. The model is that we have 103 offices, 650 offices in London. They are all independently owned and operated. Under that model, each franchisee takes their own lease and they sign a contract for 10 plus 10 years with us. To secure our rights on that lease, we have an option on every premises. So in the event the franchisee leaves, we can continue to trade from that site. The sort of main feature of WINKWORTH, sort of USP versus other franchise models or point of difference really, is the London coverage. So because I think we were the first estate agency franchise in 1981, we sort of set up in central London and moved out, and that is built a network that's fairly irreplaceable, certainly from a franchise perspective, due to the cost of entry of trying to set up an estate agency in central London these days. Obviously, in those days, it was a bit cheaper. That really sort of separates us out in a number of ways. So it separates us out because it puts us into the prime markets, and our brands operate in the middle to upper end. And it also delivers our growth. So we grow with areas that affiliate with London. Lots of people in country markets such as Winchester or the like look to London buyers to sell their house. So it's important as an estate agent to have that link, and obviously they can plug into our network of 58 London offices and offer that to their sellers. So it helps define our market positioning, and it also helps us define our growth, which is really areas influenced by London. The other important thing to say on the model is that all the billing is done through us centrally. So we collect the money directly from the solicitors and pay out to the franchisees once a week, deducting our 8% or any other costs that may arise, which is obviously good for ensuring there are no bad debts. A little bit about businesses on this slide. We're second in terms of sales agreed in London in the first half of 2022. In the areas we cover, we sell more properties than anyone else. We're established in 1835, and in brand recognition, we have a very high brand recognition. So that's a little bit about us. I suppose in terms of the period that we've been trading, the first half of 2022, I think the important thing to say is that the results are versus a boom half in 2021, driven by the stamp duty. So actually, despite the percentages down, it was quite a strong first half. In terms of sales agreed versus 2021 first half, we were just 16% down, which is quite a good performance. In terms of versus 2019, which we see as the last normalised year, where there wasn't a pandemic or stamp duty holiday, we were 50% ahead in terms of sales. So actually quite strong, but a record first half to compare against. During that time, we are a very much a people-led business. That's the whole focus of our business and everything we do. And it's been important to us, which we'll discuss in the presentation as we go through it, to focus on getting new talent in, as that's what we see as defining the success of our business and the ventures we do to generate new revenue streams. So on that note, I'll pass you over to Andrew to talk through the sort of financial and operational highlights.
Thanks very much, Dominic. In terms of the highlights, we had 14% revenue growth from our owned offices, and as Dominic pointed out, we had a very strong performance versus the pre-pandemic 2019 H1 results. And you'll see in this slide, we refer to the 2019 figures as well as the 2021 ones. We opened 2 new franchise offices, and as part of our continued investment in the tech platforms that underpin the Winkworth offering, we had the successful launch of the latest version of the Winkworth website. We'll go into detail on those aspects as the presentation goes through. In terms of the numbers themselves, the network turnover was 27.7 million. That was 24% down on H1 2021, but 29% up on H1 2019. Within those, lettings in H1 2022, a record half year, up 8% on the previous record of 2021. Sales revenue is where the revenue hit has really come through. That was at 15 million, 39% down on H1 2021. But just to put a wee bit of colour around that, in June 2021, the network sold £8.5 million worth of properties. In July 2021, the network sold £850,000 of properties. So there's a real pull forward in 2021 into H1. This year, the lettings and sales split is coming back to a more normalised sort of 50-50 split. In terms of our revenue, that was at 4.28 million, 18% down on last year's numbers, but 68% up on 2019. Profit before tax at 1.07 million was 46% down versus last year, but 84% up on 2019. We had 4.11 million in the bank at June 2022, down slightly from 4.57 million at June 21. But in the last year, we've paid out more than £800,000 of special dividends, equating to sort of 6.4p per share in that period. We declared ordinary dividends of 5.4p in the first half, and that was up from 4.4p in the first half last year.
So really just to get into the business and the dynamics, we'll go through the sort of sales and lettings revenue in the first half and how they performed. What you can see from here, really, I suppose, is first of all the sort of tough comparisons that I mentioned versus a very strong first half in 2021. I think the other thing you can see, though, is part of our business that's slightly missing at the moment. So, when you look at the central London revenue numbers, it has, and compared to 2019, it clearly hasn't grown back in the same proportion to the others. Now, in part, well, that's basically due to pandemic issues. So, travel didn't open up, quarantine was in place for a number of countries. And so the international investment community weren't buying in the numbers. We're seeing that change now. And so within our business, in our different sections, if you like, so we sort of see the country markets, the suburban markets, and central London as different markets with different drivers. We would expect to see central London, which is less affected perhaps by cost of living and more about sentiment and the international appetite for London property, start to accelerate and grow their share, supporting our overall revenue. So as I said, so then that's the sales part. On the letting side of things, broadly, it's well, the picture is one of growth across the board. It's above expectations. The lettings revenue, it's been very strong. There's been some dramatic price increases in lettings property due to a constraint of supply, particularly recent times in London as the return to cities is upon us. Again, there you can see that central London, whilst it grew significantly, has a long way to go to come back to a more normalised contributor. It should be above 2019. We do think lettings is a lead indicator there, and so we would expect sales to, it's another sign of sales following suit in central London. The other part, I suppose, is worth pointing out is management. So in our lettings and management business, the property management's the stickiest part of the business, and that has been outgrowing the lettings only part of the business significantly for a number of years now. So when you look at the H1 performance on lettings only, that's 4% increase. But when you look at the management revenue stream, that's a 13% increase. And then when you look back to 2019, you're talking about a 31% increase. So our franchisees are adapting and getting better at retaining the sticky part, not just the sort of let and forget, dare I say, element of the business. So that's positive for the durability of all our offices and the sustainability of our revenues going forward. Ooh, sorry. Fat fingers. So then what we talked about here is the breakdown of our revenue. So you can see how it all, I sort of mentioned this about Central London, usually performing, greater share of the pie. And I suppose this is a slide that shows where it is as we stand. Our revenue is predominantly driven by London revenue. But within that, Central London has been underperforming, and it has been underperforming for a number of years. Historically, it's around 20% of the pie, and I've seen up to 25%. It grew in the first half, and that was based purely on the lettings growth outstripping other areas, but clearly that's without the sales growth performing at its best. That has a sort of oversized impact on our business because obviously the fees in Central London are far higher than the fees elsewhere due to the value of the properties. And then you look at the sort of income by type, so our sort of division of sales and lettings, which we've grown to sort of 50% previously. It slipped back, but that slip back is not due to a lack of performance on the lettings business. In fact, the first half was the record ever revenue for a first half in lettings, and grew strongly and continued that trend that's been going on for many years. But clearly sales, as we said, was still was a strong part of our business, and so that's basically to see the value of the balance we have, where both performing well, and we can lean on either one dependent on the circumstances in front of us. So again, just looking at the sort of detail of the business, this is the top of the funnel, I suppose. The leading indicator for future activity as they register with us to look for start their journey. Sales, you can see the impact of the last 2 years and why we reference 2019 as an important, as the last normalised year, really, because these peaks and troughs are not normal, really. What you expect to see on sales applicants is that everything starts at its best in January. Everyone comes out of Christmas and registers, and generally every year that fades off. So that's just a normal trend you're seeing across those lines, dipping off towards Christmas as other priorities come to the fore. What it also shows us, I suppose, though, that our applicants are tracking 2021 now. Our activity since July has been a little bit above 2021, which is hugely encouraging. I suppose a note of caution that obviously the first and second half of 2021 were somewhat different in activity. It did come off in the second half, but still it's encouraging for the performance to date. The letting side of things, you can see how strong it's been. There's been a huge amount of activity, and that has been increasingly moved from initially a country lettings focus to a London lettings focus in terms of the peak activity, regions with the peak activity for us. As I said, the issue is really constraints of supply. So there's a bit of a balancing out playing out where there is very little around, and that's pushing prices up significantly to about 20% for rents in London areas, which is huge. So at the moment, that balance is leading to positive rental growth for our business, and hopefully that will continue to do. It is also something that I think is supportive of sales activity, and I think the thing to note is that this cost and lack of availability of rentals property is a driver for buyers to commit to purchasing. I was looking at a case the other day where to rent a flat in Fulham for a 2-bed flat is £2,500 to £3,000 per month. Now, if you lock in a mortgage, you can get a mortgage on a 4-bed house in Fulham for £2,500 a month. So I think that's quite a supportive driver. And as there's a continual, aside from the kind of the hassle factor of people having to turn up to offices with their offer before viewing a property because they're so scared of losing out on that property. And I think that will, whilst you can lock in 5-year rates at historically low levels, will be very supportive of sales activity.
In terms of dividends, we look to pay dividends and declare dividends on a quarterly basis throughout the year. We look to pay progressive dividends. And I think this slide is a good demonstrator of our track record on that. The blip in 2020 is clearly sort of pandemic related, but one of the key things to note from that is whilst our competitors were holding their dividends, not paying them, we continued to pay during that period, and we caught up in 2021 with some special dividends. Trading conditions allowing, we will continue to look to pay progressive dividends.
So really a bit more about the business, and I suppose the brand, which is all important to us as a business, and our licensing of it to individuals. So this is really the next slide. This is really to say, we have a cracking high street presence, had it for years. When we survey consumers each year, the number one reason generally is they know the Winkworth brand is from that footprint, from walking down and seeing us on their local high street. So that's very important to us. But obviously, we like to keep up with and evolve the business to ensure we're hitting the right channels to keep us successful and competitive in the marketplace. So Google, we've been doing for many years actually, and have in-house resource focused on ensuring that we succeed in coming up in the top 3 under the relevant searches. So a bit of explanation. Estate agents in is estate agents in each particular office. So estate agents in Battersea or in Fulham or in Islington, and the same with lettings. From here you can see that 88 out of the offices are in the top 3 under estate agents in, and in letting agents in it's 91. As I say, that's a very good route that people type into Google when they want to look for an estate agent. If they haven't walked past them on the high street, and they can come to us, and so that delivers leads to them through our website. In a broader picture, just to kind of show, because we've been doing it for a while, we have an old website and we've developed, but historically we were the first to have a website, and we have very good traction. So if you type estate agent in London, we're second generally on Google, and in the UK, despite not covering many parts of it, we're fourth. So that's very, hopefully shows we've evolved to the digital channels as much as the offline channels. And really there's a bit here about social media, because this is something we're focusing on. It is a new route to generate leads for our business and our franchisees within it. It is growing. We're investing in resources internally and new videos and content that can hopefully continue to grow that reach, to again ensure that we're just continually evolving the business to ensure that it's competitive. We want to be in the top 3 in every market we're in, and so we need to ensure that we're giving the platform to the talent we have as franchisees to succeed. This slide is really, yes, I think I mentioned it in the introduction. It just shows, I suppose, within the areas we cover, we are number 1 in terms of sales agreed. It's, I suppose, of interest is the online Purple Bricks block, which I don't think they've ever overtaken us in London, but in the country they had sold more than us. So I think that graph would have been the other way around last year, but we sort of accelerated and improved our position. So we're able to say we're the number 1 within the areas we cover versus our peers. And that's not just, we put these down because these are listed ones that the information is freely available from, but it actually covers all estate agents in the UK within our areas. So from the franchising outlook, this is what's our growth. I suppose here's the open book view of the ebb and flow of the network since the last 5 years, or 6 years, this half. You can see this year we've grown, I should probably say for those that aren't aware, there's sort of 3 routes to grow. One is someone approaches us, an experienced individual, and they have an area they'd like to open up with, and we help them set up a brand new business, and they launch it and hopefully support them through to success. Another route is existing estate agents looking to grow their market share, or perhaps move into a higher sales price bracket. They're speaking to them and hopefully bringing them on board. And the third route would be sort of existing franchisees opening further offices, or us supporting them with sort of assisted, with funds to be able to acquire competitors or lettings portfolios and grow their book accordingly. So you can understand it does ebb and flow which one drives the growth over the years, dependent on the market. In a sort of boom market, clearly the cold start, as we call it, is the most favourable route. In a more difficult market, the conversion is a more favourable route, and hopefully the opening up of second offices and third offices by existing franchisees is also a third of our business, but it's also something that hopefully shows that it's a positive network where people are happy to grow their businesses. So we have within our network now been in the country for a number of years and reaching maturity across those offices, very much reaching maturity in those offices. And we know the talented individuals we have in different regions that we are happy to back and believe they're highly capable to grow their business with our funding. So the first two, the two for 2022 on this chart are exactly that. So Crediton is our Exeter franchisee who's been with us many years. We helped for his successful business. We helped him to acquire a Tiverton business last year, and this year the Crediton business to form a sort of golden triangle for his market, also to make the 5th Devon office, and hopefully a localised regional hub that's a point of growth for us going forward. We actually lent some money to him to enable him to buy that business. Bristol is a fantastic opportunity for us. It is similarly our Bath franchisees who were the Knight Frank husband and wife team, who were sort of partners, not equity partners, came to us to run a very successful Bath office. And used to operate, one of them used to be a manager in Bristol. So there's an opportunity to acquire a lettings business there. We provided some funding alongside the bank, and they've acquired a business in Bishopston that hopefully will be the first of several in Bristol, and sort of again a new point of growth for us by supporting quality franchisees. The other things that and beyond that, I suppose we have a sort of pipeline at the moment of a number of about 5 offices. 4 of those, actually it's a bit more than 5, but 4 of those are another assisted acquisition, and then 1 or 2 from existing. One's a cold start and one's existing franchisee opening a further office. So hopefully they will come to fruition, although not there yet. And the other important thing to say, which is important to us, is we spend a lot of time ensuring that we call it sort of portfolio management, but really it's to ensure that it's as valuable to us to get a tired franchise, that maybe's been reached the end of its sort of proactive lifespan, if you like, and reintroduce new vigor to it through new sort of hungry franchisees who will acquire the business and that use their energy to take it forward. And where we've done that, we've seen fantastic results. So recent sales have been Ealing, Shepherd's Bush, Fulham. They've all increased revenue. I think they'll all beat 2021 revenue this year. The revenue increases on these, key locations, if you like, key offices. What that really means, the opportunity is probably the equivalent to opening 4 or 5 new offices. So it's a way for us to grow our revenue as well as sort of reinvigorating our existing network and making the most out of sort of key locations, key assets where we can generate 8%. So the other part of our strategy is we've looked at, let's go through it here. For those that don't know, we've taken this view that there is a huge amount of potential in certain offices. We can look at we see where the transactions are in our marketplace, in particular in London, and where we can come across some fantastically talented people, but they may not have the funds to kind of take on the office, which would obviously be hugely in our interest. So in certain situations, sorry, I've actually got the wrong slide. I'll go to the slide I'm talking about and come back to that one. in certain situations, we have acquired local franchisees, local offices where we feel there's a significant upside, and we put in place this talented person we've identified. We give them an equity reward for delivering numbers, but delivering revenue and profits, and turning it around. And really the first of which was the tutoring office, which has been a storming success. It's number one now in its marketplace. It's probably reached maturity, as not further to go after number one, but the lettings will continue to grow, and it's a well-run business with an equity partner in there. So we're in partnership. Since then, we've also done the Crystal Palace business. That is growing. It's not going to contribute much profit this year, but we'd expect it to contribute profits next year. It's on track to grow by about 20-30% this year in terms of revenue lines, again, with a partner in place to become equity upon hitting certain numbers. So we're finding this quite an effective way of delivering revenue for us, generating 8% out of an area that has great potential, and obviously securing the best talent where they may not be otherwise been able to join the business. The third one at the moment we have is the business called this commercial business, developments and commercial investments. It sits well for us. It's in its second year. It sits well with us because it is a central business that is, we're a business that leans to having a central business, not a localized business. And it is a huge part of the network that we don't have. Obviously, we're a residential sales and lettings business. So it can leverage off the network and hopefully from referrals from franchisees. It basically sells gyms or mixed-use buildings or commercial sites that can be developed into new build properties, and then that will obviously feed into developing a new build business. That new build business will then feed the properties generated from the commercial business back to the network on splits. So hopefully we generate extra revenues in the middle by exploiting a new sector of the property market. The offices benefit from new properties that they probably weren't going to get otherwise, because they went to other central new homes departments. So hopefully it's a virtuous circle to deliver growth for us. And again, it's growing significantly. It's profitable at the moment, and hopefully will deliver growth going forward. We are, as I said at the beginning, perpetually focused on this people element, and so we are looking at other opportunities where, when discussions with, as I say, the talented people is the phrase, talented people to do the next one of these, we are aware we're not changing the model, but we find this is a positive, not only for revenue, but for learnings for the front end and introducing new talent to the network. Finds is a positive avenue, but obviously we want to maintain ourselves as a fixed cost light business model capable of paying progressive dividends, and so don't want it to become the new model as such. So going back to the slide I accidentally forgot to talk about, this really is about central services, and I'll be fairly brief on it, but it's a department that calls through the database to generate. So we believe that the risk-reward balance is correct in the franchise network. Obviously, the franchisee is taking the risk and deserves the 92% of the reward. But we want the network to be as competitive as possible. So we want it to be seamless for the consumer, for the client, so they get the benefit of both the owner-operator delivering heart and soul, and a competitive platform behind them. So this goes through the database and calls clients. So, for example, someone's registered in Kensington and they've got a flat in South Ken. They'll contact them and say, "Look, would you like us to value your flat in South Ken?" And thereby join the dots. So pass that valuation over to the local office, which otherwise might have been missed, fallen between the cracks. So that delivers 10% of all valuations of Winkworth, so it's quite a positive. And actually, when you look at it with the website delivers around 25%. So outside of brand value or other added benefits, I suppose, this is delivering about, this in the website delivering a third, should we say, of valuations going to the website, hopefully separating our offering out, making it compelling to independents, and ensuring that we're able to try to target that top 3 in each marketplace.
In terms of the digital side of things, I talked about it a wee bit in the introduction. We have a vision for the Winkworth network that, as Dominic was saying, is very much people focused. So we're looking at making sure we have very strong local operators, that they have a very visible high street presence. But the critical other element to it is that their offering is supported by very good tech. And the website is a key part of that. As Dominic said, we had the first website in the estate agency field.
Yep, sorry, my fault.
And we just launched version 10 of that in April of this year. It had a new look and feel and was focusing on things like user experience, functionality, a particular focus on the mobile first design, where we get a significant number of users coming through mobile. And each of the offices has a microsite that they can tailor to give them their own particular unique flavour. Again, part of the strong local operators aspect to it. In terms of the conversion rate, so visitors converting to leads, the rate in H1 of this year was 1.63%, which is a record, and that compares with H1 2021, the old site, which was 1.21%. It's not just about the website. What we're looking at doing is sort of integrating the website with our underlying CRM databases and the like. So now that the website has been launched and is bedded down, the focus on the second half of the year will be looking at integrating with that CRM system. A number of aspects to it. We're looking at sort of personalising the visits so that we can make visitors, their journey more efficient and more effective. We're looking at analytics around that to track how people interact with us so that we can look to benefit from that. In terms of the integration with the CRM side of things, there's 2 key drivers for that. We want to drive leads to the business, and we want also to offer the franchisees the opportunities to introduce efficiencies into their local businesses. Just a brief slide on the leads side of things. As Dominic said, it's a key part, leads from the website, of generating business for the network. And although the number of visitors to the site has dropped off since the peaks during the pandemic, they're still high, and with the conversion rate that we've been able to get, we're very much in line with the last couple of years in terms of the leads being generated. There seems to be a step change on pre-pandemic levels.
So really, in summary, yes, we're looking at the half, and then looking at 2022 and beyond. We'll just go next slide. As we've sort of gone through the various parts of 2022, lettings record first half, sales significantly down, but against a sort of once in a generation period, I would suggest, in my time anyway. The market, the business has retained its sort of highly competitive nature in terms of being second in sales agreed in London, and first in the areas we cover. Our revenue was down. The impact of the wholly owned businesses or partnership businesses offset that to a certain extent, to not totally reflect the network. Dividends were grown, and 5.4p, as we like to pay a progressive dividend. We have 2 new offices. Hopefully there are several more to squeeze through this year. We see ongoing growth. We see one of our wholly owned or partnership businesses having reached maturity, but the other 2 a fair way off it. So we expect more to come from that. As I said, Tooting has got to number 1, and hopefully the others will follow. Looking forward, our aspiration is always to be the first option for agents wishing to set up their own business operating in the prime markets. and that's what we align ourselves to. We do believe those individuals need to be supported digitally as well as the sort of analog platform. So we continue to invest in evolving the platform through digital evolution. That said, as we've hopefully got across, first and foremost, it is about people for us. They are critical to the success of the business and any ventures we undertake. So we will be guided by the ability to work with those talented people. We do have hopefully more of these equity participation businesses that we'll be able to bring online in due course. We hope to keep our target of 6 new franchise offices, conversion, new franchise, or existing expansion. And I think within the markets, what we're seeing at the moment is, well, first of all, Central London has some way to go before sort of, I'd call it full recovery. I think we're seeing that now. I also think the other part to note is that the prime markets at the moment, the best part of our business, performing the best, is houses in zones 2, 3 in London. Family houses are very popular and achieving significant prices above what they were in January. And London, having not really shone for many years, really, not over sort of political uncertainty, I suppose, and hung parliament fears and all the like, has sort of picked up this year significantly at the moment. And so that's the busy part of the market for us. Within all that, we have, we retained a solid cash balance, so that one for risk against the dividend, so it gives us good security, and also so that we can take advantage whichever opportunity comes our way. We're in a position to act quickly should we wish with the cash we have on our balance sheet, and obviously no debt. And therefore, we hope that we would continue to be able to pay a progressive dividend. And that's that. Thank you.
Fantastic. Thank you very much indeed, Dominic, Andrew, for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the top right-hand corner of your screen. But shall the team take a few moments to review those questions submitted today? I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Perhaps before we just go on to some of the live questions, we did receive a number of pre-submitted questions, and if I may just read out the first one. I think some of this you have covered off market-wise, but if there's anything further to add. How are you finding the second half of the year for London rental and sales market? Has it started to slow? If markets are slowing, does that provide you an opportunity to onboard new franchisees and therefore grow your market share?
Brilliant. Yes. So the answer is it's been very busy. August is always hard to tell. It's August, but it's been a good August in terms of agreed. As I said, it's a bit above 2021 activity. Rentals is incredibly hot still. Price increases, shortage of supply. We were really, September is a key month for both sales and rentals. As everyone comes back from holidays, early indications are that it is busy. So at the moment, the property market, from our perspective, is looking quite strong. In terms of the other question about opportunities, yes. I mean, I think with every different market, there's a different approach for us. We have, as I was trying to say, in the new markets, it's new office people coming to us, starting new offices and giving it a go. And in more difficult markets, it's those almost of defensive nature, looking to grow market share to ensure profitability in a lesser transactional market. So, and then on the other side, obviously, the opportunities for our sort of more our partnership businesses where we have a greater equity stake, they arise and the prices reduce if the market is not as strong as it has been. So the beauty is with a strong balance sheet and some cash, we can adapt which way we're focused, dependent on the market conditions.
Fantastic. Thank you very much. The next question we've got here: what are you doing right that Foxtons is not, that you've resulted in your superior performance?
Everything. I would say, it's people led. I think we're long-term business. We grow steadily in a considered manner with the right people. And I think when you look at where, really in those sort of outer London areas, zone 2 outwards, we have some long-term, incredibly experienced and successful operators who are delivering. And I feel the general environment is moving towards, local business. People want to connect with a proprietor and they want to do business with them, and someone with experience in our platform, I think, puts us in a good place, hopefully, versus all competitors. going forward.
Thank you very much indeed. Next question here we've got is, notably that inventory is being hard won, with some branches yet to gain a single sales instruction so far in H2, making lettings more of a focus. The buy-to-let market's increasingly become more important in the areas that you farm, with major investors and institutions heavily involved. Is this an area where you're currently making active steps to exploit? And if so, what's the success? Where do you see Winkworth's role here?
Yeah, so I think, stock level is dependent on area and value of stock and lettings businesses underneath it. So I would say I don't think there's any complaints from any of our franchisees at the moment about difficulties. I think it's a happy camp, I suppose, is the first thing to say. Beyond that, what are our steps? I mean, there is the challenge of PRS to institutional investment in build to rent, and I think some of the interesting parts of having a commercial business in the middle, development commercial investment business, is that starts to put a foot in that camp. So there are lots of opportunities to grow that in many directions, and one of them would be to look at more the rental side, or from a sort of institutional investment perspective. That's not something we're doing at the moment, but it does, because clearly it's growing and we want to focus on its transactional investment nature to grow initially. It's something that gives us an opportunity to develop that channel in due course.
That's great. Thank you very much indeed. And the final question, which I think we did kind of cover off in the first one, but good to see current franchisees expanding into new territories: Southwest, South Coast, Norfolk, Tooting and Crystal Palace. 2 franchises where you hold a major stake and been very successful. Just a little surprised there have been no new additions. This is likely to change in the near future.
Yeah, so exactly. I mean, we're a considered business. We're not, we're people-led and opportunity-led. We don't want to get ourselves in a position where we're beholden to open over a set time frame, because we feel that might push the wrong decisions. So we are, like I said, to say, in discussions with some pretty talented people, and there are some opportunities that we'd like to see come on board. We are focused on developing that at a pace that is easily digestible, and staying true to our franchise, not stomping our franchise nature and the sort of defensive qualities of it all, and its ability to generate significant cash and pay progressive dividends.
That's fantastic. Thank you very much indeed. That does conclude the pre-submitted questions. As you can see, we have had a number of questions submitted throughout today's presentation. If I may just ask you, just click on that Q&A tab, and where appropriate to do so, if you could just read out your question and give your response, and I'll pick up from you at the end. Thank you.
No problem. The investment in digital, so that's one for Andrew. Investment digital, is this on internal platforms to increase efficiency also, or just external?
As we covered off in the sort of the digital element of the presentation, we're looking to do both. We're looking to make sure that franchisees have access to a very strong tech platform.
Very good. Okay, next one. A large number of franchisees in top 3, as you said, but small minority who are not that productive. What is your business model to improve their performance? Training, terminate franchisees, etc. So many ways, I suppose. Dialogue is really where it sits at its core. Speaking to them, if they're not in the top 3, it's not the end of the world for us. We want to ensure they're doing a good job. They are good. They have generated goodwill, adding to the goodwill of the brand, and not letting anyone down. No one's letting down another franchisee. Our aspiration is top 3, so giving them facilities and speaking to them about how they can achieve that. Clearly, if there are situations, sometimes you find that the franchising is such a personal thing that there's so many million different situations. But sometimes, if someone's perhaps done their years, it is a tiring job. Estate agency, it's highly competitive and takes a huge amount of energy. And sometimes you find that we're very old. In 1981, we started franchising. Some may have just sort of lost the pizzazz for it all. And in which case we'll speak to them. That dialogue will be, well, look, we've got people to buy the businesses. Why don't you sell, take time out, de-stress, and we can trade into a new sort of perhaps more energetic individual. Or the conversation is, look, why don't you bring someone in the same way we've done with Tooting? If you find your energy levels are dropping, there is a way you bring in young talent, and a lot of our franchisees have done this, bringing in young talent that have an opportunity to have the security of a small stake and work in an independent business with a long-term chance to take over that business. So really, and obviously we do have training and everything else. But really, it's dialogue, I suppose, to see what fits the personal circumstances. So you mentioned the Fulham example of rent versus buy costs. Interest rates are clearly going to 4.5% plus. Will central London be less affected than the rest of the country? It would also seem to change the Fulham example to renting being more attractive, at least in the short term. So I guess interest rates is the big question. I spoke to someone, read something the other day that was quite interesting. It said that the employment's the primary driver for us, that interest rates decide the size of the property by and the location, but employment's the one that decides the market, really. So that was an interesting look at it. I think, it's worth remembering 2007, interest rates were 6%. The lending criteria has changed dramatically since those days. There aren't the self-cert mortgages where people sort of didn't necessarily have the actual income. And the gearing that banks have stress tested those buyers to a far greater degree. So I think most importantly is in the direction of employment going forward. And I suppose in answer to the question of the dynamics, it does change it. Rents are continuing to grow though. And so both costs are going up, and we will see. But we're in a very different position as a business and as franchisees, I think it's important to say, than previous moments. I mean, I've been through 20 years, I've been through a few, the 2008 the pandemic. We've got very good businesses that can adapt to all circumstances. 50% of the businesses are lettings. That's grown 8% a year for 20 years. You said it's 12 years since 2008. So there is uncertainty, and you can't deny that. We will see how Liz plays out with her policies. But I think at the moment, I can say the property market's busy. And then, is the availability of rental stock likely to prove a long-term structural issue? So I think it is a concern, yes, huge concern. Rentals has always tracked wage inflation pretty closely. Usually it's 30% of take-home pay nationally and 50% in London, because people feel London properties a bit more people. But yes, it is a challenge. I mean, I think in the country, I believe that there's more investment going to buy-to-let. Really what's happened is the changes have all meant that buy-to-let requires less debt, less leverage. So, back in the day, it was, you could get 75% loan to value and have a buy-to-let, and it would sort of stack up and you wait for capital growth. Now, you can't really have more than 50% loan to value. And so it's a good investment if you're probably at the lower property price level where you can afford not to have so much debt. In London, we've seen, a sell-off, which, is that trend, that link between wage inflation and rental prices going to break? I would suggest that it may well do, because I'm not sure what the solution is. So it's a challenge. At the moment, when rents are going up, our revenue is going up. I think the balance of our business, if people aren't renting, they will be buying. So we're sort of well placed either way. But I think some of the policies have been a bit negative for rental supply in London. Sorry, what was this? Dividend covers less than 1.2 times in this half. Oh God, sorry. Let's try this. There you go. One question for Andrew. I think dividend covers less than 1.2 times this half and may decrease in future if a progressive dividend policy is pursued and earnings stagnate due to reduced sales activity. What is the board's policy of dividend cover, and would the board be comfortable with a dividend cover of less than 1?
Interesting question. I think we are committed to paying quarterly dividends where trading permits. I think it would have to be some fairly dramatic changes to our circumstances to impact on that. Short term, interesting question. I think it's something the board would have to consider if cover dropped to less than 1.
I suppose our commitment was shown by the pandemic, wasn't it?
Yeah.
Where we paid the quarterly dividend amidst the lockdown with a 20% reduction. So we are committed to that dividend, and we're able to do that because of the defensive nature of our business and comfort in the lettings business underpinning it all. So I suppose that's our view on it. We're keen to maintain that. Is this the new one? Immediate.
Yeah.
Immediate economic matters aside, how do you see the medium-term level of sales transactions evolving following the pandemic fluctuations? Are you likely to revert to 2016-19 levels? Do you think should be higher than 2016-19? So I believe they're going to be higher because I think that those were quite bad years for London, for us anyway. I'm not saying nationally. I wouldn't know all the parts quite as well, but London, we're talking pretty grim years, those years. So we do look at the comparatives of being up on 2019. It is a normal year, but at the same time, it was a pretty grim year in terms of sentiment for the property market. So I think that's supportive of levels staying above that. And I think that those are all the Q&A questions. So I hope we've covered them off. I think
I think you have covered off pretty much all those questions you can from.
Excellent. Well, good to be able to present to you guys.
Thanks very much.
That's fantastic. Andrew, Dominic, thank you indeed for updating investors today. Dominic, I don't know if you've got any final closing comments just before we redirect investors to give you any feedback.
I think I've probably hopefully quite extensive and sort of run through it all. So not particularly. I think it's, we're, as I say, we're not a short-term business. We're in it for long term. We're sort of growing progressively. We believe people are at the core. We're not going to gear up the business. We've got cash supply, cash balance sheet, enabling us to take opportunities when they arise. But we will do that as and when they are perceived value. Yeah, I think that is our summary.
That's fantastic. Dominic, Andrew, thank you indeed for updating investors today. Can I please ask investors not to close the session? You should be automatically redirected to provide your feedback, and all the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of WINKWORTH PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon to you all.